All right, everybody, I will go ahead and kick things off. I do appreciate everybody jumping on the call today. Um, we do have a full list of people. Again, I mentioned before that we have about 100 people that registered for the call tonight. So I have received a lot of basically a lot of questions. So I will at the end, I will try to fill everything up or answer as many questions as I can. We do have an opportunity if you have specific questions and you didn't want to share your information with everybody. Um, you can set up a time to talk to me individually. So, all right, let me jump over here. Um, I love showing the slide when we kick things off because if you're an average earner, and average earner is subjective, but if you've paid into the Social Security Administration for 35 plus years, you have essentially put in about $1.5 million. Now that $1.5 million, roughly 400,000 is your own money. But if you include 5-6% interest, it would have been $1.5 million. So what I find interesting is that financial advisors get this wrong all the time, and that is Social Security. So again, thank you for jumping on here. I think today is going to answer a lot of questions. And I did bolt on just a quick little summary of Roth conversions. And when you're trying to maximize Social Security, a big part of that is to also minimize your taxes. And Roth conversions can do that for you. And we do use that in our practice for a majority of folks. So again, we'll go ahead and kick this off. Um, this is our disclaimer, basically. I am not a CPA, although we will talk a little bit about taxes today. I am a financial advisor. I am also not with the Social Security Administration, and also I am not an attorney. So this is the workbook that everybody gets. You simply fill out the sheet at the end, and you will get this workbook sent to you as a PDF. Um, so why do we even talk about Social Security? Obviously, there's a lot of folks that are interested in Social Security, but why? And here's generally the basic numbers to it. And it's because there's so many people entering Social Security, people want their money, right? So there's about 280,000 people per month that are starting to get Social Security. By the way, there is not 280,000 people putting into Social Security. All right. So that we'll talk a little bit about that as well as why or what we can do in order to maximize it. But we want to make sure that we get the most out of it. By the way, you're entitled to this. So you want to make sure that you get the most out of your Social Security. And I see this time and again that advisors do not spend any time on this whatsoever. They're either not trained or they don't think that this is a big part of planning tools. But as you can see, when we get into it, it can amount to hundreds of thousands of dollars that has been left on the table just because nobody has addressed it with you. So we are going to talk a little about that. Back in the day, there were pension plans and, there aren't simply that many pension plans. I mean, if you're a government worker, okay, you get a pension. Some of the school districts, things like that, firefighters, police officers. But by and large, unless you're working for a government agency or municipality, you simply don't have much in the way of pensions anymore. They really have gone away to the pension plan is you have to save for yourself. And oh, by the way, you'll get Social Security. Social Security isn't much money, but you'll see 50% or 65%, according to the stats, get more than half of their money from Social Security. So the average Social Security payment is $1,800. That means that 65% of people are getting roughly $3,000 a month in Social Security, which I find amazing. I mean, not Social Security, but in retirement pay. They're getting about $1,800 a month in Social Security, about $1,800 a month in savings. So that is not much money. And if you are relying on Social Security, we want to make sure that we get the most out of it for you. All right. So, you insure your home, car, health. Um, do you insure your retirement? And really, this just lays into the fact that if you are going to live a long, healthy life in retirement, you want to make sure that you're getting the most out of it. So Social Security is a big, big part of everyone's retirement plan. All right. It's kind of the cornerstone. And that is because we need to ensure that if you live a long time, and again, here's the odds or chances, you get 50-50 chance if you're married and you're 65 years old, that one of you is going to live to 93. Now you live to 93 and you don't budget properly, and it can detrimentally hurt you in retirement. So we want to make sure that we're maximizing our benefits for you. But on the second side of that, remember it's a two-sided coin. We want to also make sure that we're going to minimize the taxes, and we're definitely going to cover that towards the end. So this is a fun little slide. This shows you the oldest living person here in the United States. Born in 1907, so that's substantially long life, 117 years old. So if you had taken Social Security and you shorted yourself by not doing it right, you can see that you just want to do it right. So the focus for today is the benefits, the basics of their benefits, strategies for married couples, divorced couples, and also widows, widowers, and taxes. And again, with the taxes, we'll talk a little about how you can lower your taxes or minimize the taxes you pay on Social Security. But we're also going to talk about if you converted some of those IRAs and 401k plans, how much money you would save in taxes there as well. So basics of Social Security, how do you qualify? You had to work at a job where they're paying in the Social Security, and it is 40 credits, which equals about 10 years of work. Okay, it's not exact, but it's about 10 years, because if you worked one quarter and you earned under $1,500, it did not count. So you have to have minimums. There are minimums to Social Security. And it chooses the highest 35, not your entire work schedule. So if you work 30 years, 5 years are zeros. Okay. You don't have any. So it's a zero. Conversely, if you work 50 years, I've got one lady that worked for Palm Beach County School District. She is at 47 years, 48 years working with the school district. What happened is that she retired. The year she retired, her husband passed away, and she just said, you know what, I'm just going to go back to work. She didn't like being alone, so she just went back to work. So anyhow, highest 35 years. If you work more than that, it doesn't count. Now, there are certain exclusions. In other words, some government workers have not paid into it, and there's a government pension offset. They also have windfall elimination provisions. There are certain things. And also, by the way, so if any of you are Canadian or have lived abroad and you get some sort of old pensioners benefit, your Social Security will be deducted by that amount as well. For instance, I've got a lady that lived up in Canada. She came down here to the States. She gets, I think it was like $200 a month from Canada, Canadian dollars, by the way. But she gets a deduction of $200 a month from her Social Security payment because she is getting another pension. So you got to be careful of that. If you go and you don't claim that and Social Security finds out, they will claw that back. They will take all that money back, and potentially with a penalty. So you don't want to get caught in the government's wheel. How does it work? Every time you get paid, 6.2% goes to the IRS. The other 6.2% your employer matches. So it's a total of 12.4 goes into Social Security Administration. And the way it works is that money comes right in. Your check gets cashed and it goes right out the back door. The money that you are putting in today, if you are putting money in today, goes right to your neighbors that are getting Social Security. So that's the way Social Security was designed. It wasn't a slush fund where it saved up money. They could have designed it correctly. They did not. There's repercussions to that, and we'll cover that here in a second. So solvency, again, everybody talks about this. Is it going to be around? I always get people saying, "Oh, I'm gonna just start it at 62 because I don't know if it's going to be around later." You don't have to worry about that. They will fix it. Starting at 62 versus waiting is not a good strategy. You definitely want to wait. especially if you're working. 2010, it went in the red basically. Now it's fully funded through 2035. All right, so let me caveat this. And by the way, I add little stories in here, so this sometimes gets a little bit longer than typical, than normal. But I think it's important for you guys to understand how some of the stuff works. It's fully funded through 2035. That is assuming that all interest rates stay where they are. Okay, and also the returns. So 2035, and they assume that we're going to keep getting more and more people into the workforce, so forth and so on. Jobs number just came out. It was not good. Looks like we are finally going into a recession, which means that, just on a financial note, if you got a lot of money in stocks, probably now a good time to circle the wagons on those things. Certainly you can talk to me about that, but 2035. So in 2036, it's only funded for 83 cents on the dollar. So now a couple things can happen, and there's four basic proposals, right? Four ways that they can fix it. One is they could increase the minimum retirement age today at 62. They could say, okay, you can't get Social Security until age 64, 65. By the way, back in the day when this came out, Social Security came out, the average life expectancy was 65, 66. So they didn't expect to really be paying this benefit. And it was never adjusted for age, because what happened is once people got a taste of it, and this is the way any government plan works, once people got a taste of it, they said, you get rid of it and we're going to vote you out of office. And no politician likes losing their job. So they never fixed it. They've just kept it the way it is. But they are going to have to do something. They could increase full retirement age from 67. Most everybody on this call now at 67. And they could say, you know what, full retirement age now is age 70, maybe make it 72. Increase the payroll tax, again, the 6.2% that you and I put in, and also the 6.2 that your employer, they could raise that. And these are band-aids, by the way. This is not going to fix the system. Or they could reduce benefits. So they'll do some sort of hybrid fix on these kind of things. But the easiest way for them to do it is to change some of these numbers. Unfortunately, 2035 isn't very long from now. It's only 11 years. And assume that this number is always going to get shorter. So by time 2035 rolls around, this number will probably be 2030. It's just the way things go. They never plan correctly, but you go to ssa.gov and you can see all these numbers. So here's how you get your benefit, and here's how it gets determined. In this example, I'm going to use 66 for full retirement age. So 66, I'm going to say you get full retirement age. Again, most everybody here, it's age 67 now, but it's just easier. I use the 67 for the numbers. So if you retire early at 62, you will get 75% of your benefit. Pretty simple. You stick it out to age 66, you'll get 100% of your benefit. And at age 70, you'll get 132% of your benefit. So as you can see, it increases about 8% per year. And by the way, it's 8% per year, but it actually increases monthly. So it's not, you don't have to wait a full year to get an increase in your benefit. You only have to wait incrementally 1 month, and you'll get 1/12 of 8%. Excuse me. But you will get increases along the way. All right. So that's pretty simple. You're getting your own benefit. You're single. This is how it works. Pretty straightforward. So there's 3 security benefits. Retired worker benefit. Again, this is where you get your own money. You put the money in, your employer puts your money in, you're going to take your benefit, and this is what they call retired workers benefit. Spousal benefit. This is where if you were a homemaker or you didn't work, your spouse worked, you are entitled to half of their benefit of their full retirement amount. Okay, this is important, and I'll explain that here in a second. But spousal benefit, you cannot get increases if they decided to wait. You can only get half of the full retirement benefit. And widow or widower survivor benefits, we just call them survivor benefits. And that's after somebody passed away, you would inherit their benefit. I had the question earlier, can you take both? No, you're only entitled to one benefit, and it's the higher of the two. So if the spousal benefit or the survivor benefit is higher than your benefit, you'll get more. If the spousal benefit is lower than yours, it doesn't get added to yours. You only just keep your benefit. All right. So that's people ask me that question all the time. So 2015, essentially Congress got rid of the bells and whistles, the file suspend. People were gaming the system and Congress just said, you know what, we don't like that. We got rid of it. So can't do it anymore. Considerations for married couples. So here's a quick little write-up. Spousal benefit. You have to be married for at least 1 year. Okay, so you need to be married for 1 year. Primary worker must have filed. This is a thing. So if the primary worker has not filed yet, you cannot file for spousal. You have to wait until the primary files. What that does, that jams you up. If the primary says, you know what, I want to maximize their benefit, my benefit at 70, and spouse says, hey, you know what, it would be nice to get half of your full benefit, and you are at full retirement age now, doesn't work. Spouse has got to file before you get the spousal. Anyhow, I'll show you that. And 50% of the spouse's primary income amount, PIA's primary income amount, not the benefit amount. It's not the amount that your spouse is getting. Remember, it could be higher because you could have waited. It is that 100% number. So that 100% at 66, maybe it's 100% at 67. Quick little illustration. We're going to say John here gets $2,000 a month. Jane gets $1,000 a month because that is half at her full retirement age. Okay. So this is how it works. With spousal, you actually, if your spouse takes it early, you end up even getting less. Normally, if your spouse took it, or if you took it early, you would get 75%. Well, if your spouse takes it early, you also lose an additional 5%. So important to have your spouse at least hit age, their full retirement age, because you don't also get any more credits. Remember I said, you see here, this 100 column, you only get 100% of the benefit that they get, which is 50% of this amount, and never increases. You never get any increases by waiting for your spouse to get a higher benefit. It just doesn't work. All right. So survivor benefits are a little bit tricky. It's easy to understand, but it is just slightly tricky because again, you don't get two benefits. You only get one, and it happens to be the larger of the two. Okay, so it's important to know you only get one benefit. It also knows that you only get the larger of the two. So some of the common mistakes that we see is that the higher wage earner files early. Again, 2 slides ago, I showed you that doesn't help the spouse. Both delay past full retirement age. No one claims a spousal benefit. That doesn't help you as well. And some of the considerations, excuse me, if you are divorced. So you got to be married for 10 years. If you want to file a divorce benefit, you got to be married for 10 years. Now, you could have been married for more than 10 years to multiple people. So you could take the highest one of all of the spouses that you have, which people do. So, and also you can't be married for 5 years, get a divorce, and then be married for 7 more years and say that you were married for 10. It has to be 10 years consecutive to the same person. Yeah. Anyway, I'm just splitting hairs, but it is nuances that get people caught up by not getting their benefits. You cannot be currently married. In other words, you can't go back and get remarried. You can start your benefit and get married, but you cannot be remarried and get this benefit. So again, same benefit amounts and reductions apply for claiming as they do for spousal benefits. There is a slight reduction. And you have to be divorced for 2 or more years. So you need to be married for 10. You got to be divorced. And then you have to wait 2 years until you get that Social Security benefit. Okay. So this a lot of folks miss this. but you do have to be divorced for 2+ years. All right. Some of the questions we hear from those that are divorced. Basically, if you're divorced, don't worry about it. Don't worry about what your spouse sees or doesn't see. They do not get notified. You just get notified how much your benefit can be. So we need to know that if we're going to do any sort of analysis for you. But suffice it to say that your spouse is none the wiser. So if you're on bad terms, they do not know that you are going to claim for their benefit. And they can't stop you either. So if you think, oh, if they find out, they're going to stop your benefit, they can't do a thing. Social Security doesn't even notify them. All right. So let's skip over to widower benefits, survivor benefits. Qualifications, obviously, your spouse has had to have passed. You need to be 60 years old. So here's one special caveat to this is that you only have to be 60 years old. You don't have to wait to age 62. So it is one of the special carve outs for survivor benefits. You have to be unmarried until you reach age 60. Okay. So you have to be unmarried. If you are 59, 11 months and 2 weeks in, and you say, you know what, I'm going to get remarried, you will lose your benefit. You cannot get remarried until after age 60. So I personally have not seen it, but there's a partner of mine that has worked with somebody that they were just getting ready to get married. And so he basically, they held off on the marriage just for a couple of weeks so that she could get her benefit. So you need to be married for a minimum of 9 months. That's for people that are trying to game the system again. They don't like that. If you got somebody with cancer, it's terminal, and they say, oh, you know what, let's just get married and you'll get my benefit. Doesn't work that way. You got to be married for 9 months. There are exceptions. For instance, a married couple gets married. He gets stationed over in Iraq and gets blown up by IED or something. That is a special circumstance, and they would award her his benefit. Okay. So they're just trying to stop people from gaming the system. All right. So here's a quick example. Widowed client. Her husband is 64 when he passed away. He had never elected. So these are just some of the details to it. But his benefit at full retirement age would have been $2,150. Jane is 5 years younger, so she was 59, and she remained unmarried. Remember, I said this is a big caveat. You got to make sure that you don't get remarried. And Jane's estimated benefit on her own at 62 is $1,197. So I got a quick spreadsheet. And really, what this is this is say, okay, well, Terry, here's an example of what I have or what is going on in my life. How do I maximize this, knowing this? And we say, okay, well, you really have 3 strategies. First strategy is for you to file for widow benefits at age 60. So the key here is that you're able to file at age 60 for the $1,537. So we have an average life expectancy of her for 85, right? Because we have to guide these things. So her total benefit would be $461,000. We say, okay, that's one strategy. You can do that. So her benefit, though, would stay at $1,537. Strategy number 2, we say, okay, file for your benefit at age 62, client. You'll get $1,197. So you have to wait 2 more years, and you're actually getting less initially. All right. So it's important to know that. But you can switch to widow benefits at age 67, which is her full retirement age, and you can get the $2,150. So you can see that here. So for her, it's a jump between 460. Now she's getting 538,000 in retirement. So, about $70,000 more. We say, or you can do the third strategy. So third strategy, she can file for widow benefits. So she is getting $1,500. Oh, sorry. She is getting $1,500 at age 60, but she delays her benefit to age 70. At age 70 for her, she's getting $2,108. So we add all this up, and she gets 563,000. So as you can see, you can get $100,000 more just by knowing what strategy to use. And again, everybody's strategy is different, but this works for widowers, and it also works if you are single and married. These are the strategies that we need to figure out for you. And it's important to know where you're going to maximize. Now, can you work? Yes. When you file for Social Security, is it smart to do that? Well, it always depends. So if you start working or you're working part-time and you haven't reached full retirement age yet, I say you got to look at how much money you're going to make. If you're going to be making more than $22,000, we would probably suggest that you do not start Social Security. If you are making less, then you are okay. So 22,300, that's when the government reaches into your pocket and takes back your Social Security. And they take back $1 for every two that you earned over. So if you earned $40,000 over, say you earn $62,000 in a year, they will go in there and they will take all $22,000 back. Okay. Super important that that doesn't happen to you. And please do not talk to a neighbor or take your neighbor's advice. Talk to somebody that's been doing Social Security for a while, and make sure you get steered in the right direction. This is one thing, it's my pet peeve that I see people doing because they think that they're just going to get that 22,000, or they think that Social Security is going to go away. They start early and it just screws them up because you can't go back. And then, well, you can do it in one instance, give them the money back and then reset the button. But once you start it freezes your Social Security for life. And once it's frozen, it's frozen. You can't go back and fix it. All right. The other strategy is if you are the year you are retiring, you can actually earn more. We always suggest that if you're earning $60,000 to $80,000 a year, you're probably better off doing it the year after you turn full retirement age. So anyhow, a little bit about tax. Again, we're going to segue into the tax. For those of you who joined, I see we had a bunch of people join after I got started. As we go through here, if you want, you can click on the Q&A if you are watching us through Zoom. And I will come back and circle back and answer the questions on the Q&A. And I also have, I will post some stuff on the chat as well. So, all right, back to this. The taxes portion, there is a way that they determine how much your Social Security gets taxed. They have a whole separate form for this. And the interesting thing here is it's 33 pages to figure out whether or not your Social Security is going to get taxed, and if so, by how much. So it's kind of expansive, but let me go through it here real quick. It's pretty simple, though. They have a whole nother term they look at. It's called provisional income. And essentially, it's means-weighted testing for benefits of Social Security. For instance, if you've paid money into it and you're Bill Gates, you really probably can afford to pay the taxes on it, even though it's an entitlement you put money into. It's for insuring people with lower incomes. And so that's kind of generally how it came about. So you, on this form, these are the line items. So line item number one is how much did you get from Social Security? In this example, it's 12,000. You just divide it by 2. So line 2 is 12,000. Line 3 says, all right, combine the amounts from your IRS tax form 1040. Okay. And we're going to say it's $18,000 plus the 12. So that this person on provisional income is at 30. And I'll explain how that comes about. But you should know this. This is an important concept, is that if you have money or you're taking money out of Roth IRAs, remember how I mentioned that we are going to talk about this? IRAs do not count towards this number, the 18,000. So you could take $25,000 out of a Roth IRA. It will not push up the amount you pay in taxes, and it will not push up the amount that you get taxed on your Social Security. All right, so I think, oh, one other caveat to this is this. If you are getting municipal bond income, it does count. It may not count towards taxes because it's tax-free, it's muni bonds, but it does get counted in this calculation here to determine whether or not your Social Security gets taxed at a higher rate. And this is really it. So for a single person under 25,000, half your Social Security gets taxed. Between 25 and 34, 50% gets taxed. Oh, I'm sorry. If it's under 25, it's zero. So none of your Social Security gets taxed. Between here, it's 50%. And if you're single and earn over 34,000, 85%. So you always get 15% tax free. But if you earn over 34,000 or 44,000, if you're married, you will have 85% of your Social Security added to be taxed. Okay. So quick example, client 64 and 62, $34,000 worth of Social Security income if they filed at 62. This illustration is to show you what the difference can be if somebody filed early or if we file late, right? So we don't know. Somebody comes to me and says, look, I've got $34,000 in Social Security income, my wife and I, if we file at 62. I say, okay. They have $750,000 for retirement saved in 401ks, IRAs, things like that. I say, okay. We are going to assume that they're going to get a 6% average annual return. And we also need to calculate in here a cost of living increase. Everybody that does this needs to have a certain amount of cost of living increase, but you're going to get 6% return, and we need to increase the amount by 3%. And the client says, you know what, my wife and I, we need $70,000 to live on after tax to make ends meet during retirement. I say, okay. So I put all this together in our planning software, Social Security planning software. And I'm going to say, okay, well, your average life expectancy is 86 and 89. Usually males would be 86, females are 89 for 65-year-olds. I say, okay, well, what does it look like? So we're going to plug this in our software. We're going to say, this is what it looks like early. Say, well, all right, you got the red line here, which is $70,000, increase 3% per year, cost of inflation. Anything above that is going to the IRS. Taxman's got his hand out. But as you can see, we're good and dandy here until we hit year 23. And we're like, well, what happened? Remember, this is what happens if you file early. Well, what happened in this case is this couple runs out of money. So you would think with $750,000 and filing for Social Security early, they would be fine. But they're not, because they needed $70,000. They drained their 401k plan because they took Social Security early. And what happened is that they ran out of money. That is not a good plan. Okay. That is not a good plan. You do not want to be running out of money. We say, okay, so now let's flip it. Let's see. So let's go ahead and do an analysis and see what it would look like if you waited. So as you can see, same curve, same red line, 70,000 increase, 3% cost of living increase, inflation. Again, everything above is taxes. So you can see here, well, one thing that happened is that they still were able to manage to get money all the way out to year 34. And by the way, I'm sorry, and the 34th year, the husband passes away and the wife is left. But as you can see, they managed to extend the number of years that they have money in retirement. And also what happened here? Well, the orange line shows that they had to take more money out early out of their 401k plan. But by doing that, and by maximizing their Social Security, by waiting the age 70 to take it, you can see that they increase their benefit you say, well, geez, they're able to increase the benefit. That's good, right? We absolutely don't. By the way, it's one thing to go live with your kids if you want to go live with them when you get older. It's another thing entirely if you have to go live with them. All right. So you want to make sure that we're doing these plans right and that you don't run out of money. So the blue line is optimized. In other words, this is the taxes they had to pay because they took more money out early. The orange line is the amount that they had to pay if they did early federal tax. And so you scratch your head and you go, okay, what's the end result of that? They were able to, first off, get $186,000 more out of Social Security, which is important. You do Social Security, make sure you get the money for longevity. They get 14 years of portfolio longevity as well. They get roughly $35,000 less in taxes. They had to pay $35,000 less. So let's add all this up. So you got $160,000 or $186,000 more. You didn't have to worry about running out of money in retirement, and you ended up paying $35,000 less. This is why we offer this analysis for folks, because if you're in this situation, you want to make sure that you're maximizing the amount you get in Social Security. So a couple of things about your Social Security statement. You can go to ssa.gov. That's ssa.gov. And they will pull up how much you get. Your statement, though, is a little bit off, and I will explain. There's no cost of living increases applied to your Social Security statement. Meaning, if your Social Security statement says you're going to get $2,000 a month when you are turned 67, it does not include any cost of living increases over the years. Okay, well, they don't know what it's going to be, and government agency is surely not going to guess. So your benefit is going to be less. On that sheet of paper, it will be higher, though, when the time comes. And it assumes that you work until age 62, full retirement age, which a lot of you use again 67, or age 70. Work until, okay? They're going to assume that you are going to be working if you decide to take Social Security at age 70. And they're also going to assume that these are your highest years. So in this respect, it's over-representing the amount you're going to get on your statement. The first one here underrepresents, okay? The analysis software tool that we use takes into account both of these. So it's tons more accurate. And again, it's for your record only. For instance, if you have a spousal benefit or you have a inherited benefit or divorce benefit, it doesn't know. The statement you get does not know. And unfortunately, Social Security Administration is not supposed to tell you if somebody's living what their benefit could be, because they are, the HIPAA rules and all these other rules. They're really not supposed to tell you. And it makes it hard for us as planners and for you to figure out, okay, well, I need to figure out what I'm going to do. So we need to do something. And it's no advice. They again, they don't tell you how to maximize your benefit, whether you should file or whether you should get spousal, wait a couple years, and then, get your own benefit. They simply don't help you out with that. All right. So here's a Roth conversion example. Again, for those of you that have $500,000 or more in 401ks, IRAs, 403bs, things like that, this applies to you. All right. I'm going to show you an example here of a client, but it is, I show this to a lot of folks, and it does benefit them quite a bit. So this example is a married couple. Both of them were government workers. So she worked for government, he worked for government. They did not need the investment income. In other words, they didn't need much. Their pensions covered most of what they were getting. So they didn't really need much. And they had saved about $1.3 million in 403Bs and 457 plans. So they had about $1.3 million that they had saved. And they said, all right, well, we saved about $1.3 million. What does it look like? Well, if you don't do anything, and again, this is all part of the tax planning or software, but this is your taxes without using a strategy. You can see here, where 2046, this couple is going to owe, this is the amount they owe in taxes. This isn't the amount that they're going to get. Okay. This is the amount they have to pay in taxes. So right here, they're at about $300,000 because the RMDs increase as you get older. So here, 2052, they were looking at $500,000 in taxes. $500,000 a year in taxes, and they only had $1.3 million that they had in 401ks and IRAs. So we say, okay, this is the situation. You are going to end up owing a ton of money in taxes. They just keep getting bounced up and up in the tax. By the way, you have to do this because this is the a required minimum distribution chart. So we say, all right, well, what happens if we do a Roth conversion? In other words, we take some of those 401ks and IRAs that you have, 403bs, and we just convert those in the Roth accounts. You say, well, what does it look like to the client? Well, as you can see here, the red line is what they would pay in taxes. So they are paying more in taxes today. All right, so this does show you having to pay more in taxes. If they did not do a Roth conversion, they would owe the gray bar. But if they do a Roth conversion, they owe the red bar. And so you can see, they're just under $100,000 a year in taxes. So, well, geez, that's quite a bit of money. So you fast forward here into 2037 and beyond. The green is all the money that they would save by doing a Roth conversion. So you say, geez, is it worth it to do it? You either pay the taxes now and you get this benefit here. What's the net of it, right? Because it doesn't really help you if you don't get a benefit from it. Again, that's where you showed. This software estimates that they will save roughly $1 million, save by doing Roth conversions. And that's on a client that has $1.3 million. This works if you had $500,000 or more. This absolutely is another strategy that advisors simply do not know or just don't know how it works, or they're not willing to do it. I will say that sometimes I will show this to a client and then they'll run it by their CPA, and the CPA will call me and say, well, my client's having to pay more up front. I say, yeah, that's true. By the way, accountants generally don't like seeing these. I say, well, if they can save $1 million over their lifetime, would you rather them not save $1 million? The CPA is like, well, I just don't think that. I go, well, it's all laid out here. And then the CPA will scratch their head and they'll go, well, all right, for this client, it does make sense. It doesn't make sense for everybody. All right. So just so you know, it doesn't make sense for everybody. But this is an analysis tool that we offer for everybody that came on this call. And we'll show you how to get this. So this is important. So not only did they get $1 million more in tax savings, but they ended up with $3 million more in assets that they can give to their kids. They can give to charitable institutions. They can do whatever they want with it. But net, they end up with about $3 million more in their total assets over time. Okay. So it's important to look at these kind of things. So here's what you get from us. You get the workbook. You also get your Social Security analysis, and you also get your Roth conversion workbook as well. So your personalized Social Security analysis, it's going to be individualized for you. It's going to break it down. It's going to, the best date to start and why. It'll also tell you, okay, if maybe you need to extend it 2 years and then start it, but it is going to give you a full report. It's about, I think it's about 40 some pages long. And it just gives you different scenarios, right? It's good to plug everything in here and say, okay, what does it look like if I retire sooner than later, and make an educated decision. Remember, all this is for you so that you can make a decision, because this is going to single-handedly be the most important decision you have to make regarding retirement, and that is your Social Security benefit. All right. So again, you get your Social Security analysis, and it also shows you what your break-even date is. So it's interesting to see that. In addition to whether or not you're single or married or divorced or widowed, it's going to now compare not only your benefit, but it's also going to marry the other benefits that you potentially have are available to you. And so it's going to tell you, what's your desired income, how much you're going to take, where are we going to start your Social Security? If we start yours, if we start your spouse's, when we start your spouse's. So full breakdown, okay? Full breakdown on all the different variables. It also shows you the break-even analysis. I like this because a lot of folks say, if I start it now, I'll have more money. But if you lived past, in this example right here, 78 years old, you are better off waiting to get Social Security at age 70. So this is the break-even analysis. And this is important too, because if you don't have longevity in your family, or if you are sick, I've got a client that's on dialysis. He's had a quadruple bypass. He's got a lot of health issues. And so when we did his, we didn't even look at the waiting. We immediately signed him up as soon as he retired. We immediately signed him up to get his benefit, because he simply, health wise, his life expectancy is not that long. So, unfortunate, but again, you need to make an informed decision. You need to know what's available to you in order to do that. So your personalized Social Security analysis, again, we talked a little bit about that. And also if you're married, who should start the benefit and when. So again, this is one of the misconceptions, is that unless you figure it out mathematically, you don't really know. Should you file for your own? Should your spouse file for hers or his? Should you wait until you're age 70? All these things come into play. So if all we did was do an analysis for you and show you how you could increase your Social Security by 50 to 60,000, would it be worth it? I don't know. Would it be worth it to figure out how to earn more money in retirement? And also, if all we did on the Roth conversions was potentially save you, let's say we saved you 70 grand. All right. This happens to be $1 million that we saved this couple on $1.3 million. But let's say you had 50,000 or $500,000 and we did Roth conversions, and this number goes down to 50 or 60 or $70,000. Wouldn't it be worth to know what steps you needed to do in order to minimize your taxes? Okay. Again, we put these together for you. So here's what you're going to get, and I'll show you how to get your workbook. But you're going to get the free Social Security analysis. You're going to get the workbook, which again is a PDF that you're going to download. And you're also going to get the Roth conversions as to what the potential is, how much money you could save by doing Roth conversions. All right. So you simply, you can schedule a time with us. You just go to www.maxoursocialsecurity.com, and we will start the 10-minute timer. But if you go down to the bottom of the form, Max Our Social Security, you got to put the www there. So just so you know, I get that question. You have to type in the www.maxoursocialsecurity.com. To get the workbook. This is at the bottom. And if you want your Social Security analysis and Roth conversion analysis, you just click on the yes button here and hit submit. It takes you to a calendar where you figure out when the best time is to meet with us. I would suggest that the calendar does fill up pretty quick. So if there is a certain time that you would like, just pick the time, and then you can always come back and fix it afterwards. So again, maxoursocialsecurity.com. Let me go over here and post it again to everybody that is in the Zoom call chat. Let me go over to the chat. Where's the chat? And this should go out to everybody on the call again. www.maxoursocialsecurity.com. Again, you just cut and paste that, throw that up into the website, and that will get it. Let me check to make sure that everybody can see that on. I want to make sure everybody can see that on YouTube. Let me try to get my YouTube blog up. Okay, that's a YouTube. I'll pull it over here. Let me go ahead and post that up there for everybody on the YouTube. And all right, so let me post this up here. All right. Okay. So again, I saw it pop up. You have to put the www there, but it's www.maxoursocialsecurity.com. And I will go ahead and answer some of your questions. All right. Go ahead and get this out of my way. All right. So jump over here to the Q&A for a second. All right, so we'll answer Q&A again for about 10 minutes, and then we'll close up here at about 8 o'clock. All right. So again, if you got questions, just jump over to Q&A. You can type those in, and I'll answer those now. All right, let me go ahead and answer that one. That one's done. I got another question. How long a webinar be? It'd just be another 10 minutes. So I answered that one. Answered that one earlier. How much money are we allowed to make in retirement? That was on that one slide. If you're single, you're able to make 22,000. If you make more than 22,000, the IRS takes $1 back for every two that you make. All right. So again, you don't really want to make anything over 22,000 unless you reach full retirement age. If you're full retirement age and you're making, 30 some $1,000, say, okay, well, now you can make your 22 or 28, whatever you're getting Social Security, plus you're able to earn and they don't penalize you. But we just got to figure out what works for you. If you can, you want to try to wait. 62, I qualify for my ex-husband's Social Security payment. He gets more Social Security pay. I work. Can I collect my Social Security benefit now and switch to bereavement later? I think you're assuming that it is not really bereavement pay, but spousal pay. And the answer is yes, but you got to make sure you run everything through Social Security. In other words, I think what she's saying is, can she start her Social Security now? And this was in the illustration that I gave. Start her Social Security now, and then take her husband's payment when she turns 67. And I'm assuming 67 is probably your age. The answer is yes. However, you could, in the example that we did, start your husband's payment now, and when you get 70, take your payment. Again, I don't know what your benefit amount is. So if you want, set up a time with us and we'll pull that apart for you, help you pull that apart, and help you make a good decision on that. All right, so we answered that. Somebody said, thank you. You're welcome. We do a lot of these. For some of you that have been to these before, I always like adding something a little bit new to these. The Roth conversion thing, I was getting a lot of questions on, so I figured I would just throw those slides in there. But by the way, if you do have money, have more than $500,000, it does help you by looking at Roth conversions. Now, it may not help you as much as that one example that I threw up there for, saving $1 million in taxes. But if you could save, like I said, $100,000 in taxes, and also by doing the conversion, it can lower the amount of your Social Security gets taxed. I have helped people get into the 0% tax bracket. And it's not that they don't get any money, they get loads of money. But what we were able to do is max out, 30% is roughly, and Roth conversions. We get all the money over to Roth accounts. If you take all your money out of a Roth account, guess what your Social Security is going to be taxed at? 0. You essentially can live out the rest of your days and pay 0 in taxes. Now, it gets a little confusing if you've got real estate or secondary properties. You get a pension. It may make it a little bit harder, but we've helped many, many people get in the 0% tax bracket, and it really looks good. It's not the easiest thing to do, but certainly we have to evaluate it and see if it's right for you. All right. So Social Security monthly payment, is it taxable, federal and state? The answer is yes, if you earn over those amounts. Remember, I showed you actually, let me jump back here. I can show you those real quick because I know you're specifically asked that question. If you earn here, I think this is what your question is. So if you earn under $25,000, you will not pay any money in taxes, okay, on your Social Security. Remember, you take half of your Social Security and add whatever other income you have. Those two numbers dictate this provisional income number, and that provisional income number, which is what this chart represents here. Provisional income is got to be under 25 for you not to pay any taxes. Under 34 is 50%, and anything over 34, remember, is 85% of your Social Security is taxed. It's not taxed at 85%, but they just have to throw that 85% or whatever you made on top, and you'll pay whatever taxes, whatever tax bracket you're on or in on that amount. I know it gets a little confusing sometimes when you look at this, but just suffice it to say, the government has its own way of doing it. And if you're taking money out of Roth conversions, you don't have to worry about it. This is confusing. I'm 65. My wife and I both lost our jobs on August. Approximately 98. I'm not going to read your name, obviously. We've been scrambling to get our finances in line and figure it out. Great service. Saw you a few times before. Signing up. Thanks for the call today. Okay, yeah, you're welcome. Again, sign up. We'll try to figure out what works best for you. If you have to retire early and you have to take Social Security early, you do. If you've got money set aside, maybe it's better for you to extend. Again, we don't know till we do the analysis for you, but that's why we offer that analysis for everybody. All right, so that, I think, wraps it up, unless somebody has another question. I have a couple other questions in here, but they are better off if I answer them offline. I do appreciate everybody joining this call. One of the interesting facts, and I used to do this this is part of actually a program that I used to teach at colleges, just on Social Security. This is probably the 1 hour section. It was a 6 hour course, but suffice it to say, this is important. Everybody on this call is getting Social Security. It's important that you find out how to maximize this for yourself, because again, the whole point of this is that you're going to get it for life. If you're going to get something for life, you might as well make sure it's the best deal you can get. So I do appreciate everybody being on the call. If you know anybody that needs to or has questions, make sure that you just send them our way, or send them on this call. The replay will be available. Probably won't be available till tomorrow, I've got to go in and edit the first 30 minutes and take that out. It's just me sitting on the computer. So again, I appreciate everybody's time. Make sure you take advantage of the free resources that we offer you. And thanks again.